From the opinion pages of the Wall Street Journal, this is Potomac Watch.
Stock markets around the world plunge after a so-so jobs report for July on Friday. Monetary tightening in Japan while the Federal Reserve held serve. Did the Federal Reserve make a mistake in not cutting interest rates last week, as some people on Wall Street aver? And what's behind this market rout? Is a U.S. recession in the offing? That's our topic for today on Potomac Watch, the daily podcast of the Wall Street Journal opinion pages. Welcome. I'm Paul Gigot, the editor of those pages, and I'm here with my colleagues Mary Anastasia O'Grady and Joe Sternberg. Welcome to you both. So a couple of bad days here in financial markets, really bad days in Japan with the Nikkei index falling 12% on Monday, the worst day since Black Monday, as it was called in 1987. Joe, you're too young to remember that, but I'm not. Stocks in Europe also fell, although less than they did across Asian markets. And U.S. stocks are down sharply as we tape this program, though up off of the worst of the morning trading. The Dow is down about 2% and NASDAQ about 2.65% as we speak. Who knows where it goes from here? So the first question, Mary, is what's behind this sell-off? Is it a signal of larger economic problems?
Well, I think that the market was waiting for some reason to correct. I mean, let's look at how sharply it's been up. We've just gone straight up since January. And whenever that happens, everybody's kind of, on the one hand, wanting to hang in there because they don't want to miss out. But on the other hand, they've one foot out the door when things look shaky. So I think that this is, in some ways, this is a very normal correction. It was a needed correction. And, we have to wait and see if the fundamentals warrant, a more serious contraction of the U.S. economy.
So, Mary, just to cut in here, so you think valuations got ahead of themselves?
They did. And, let's remember also that the Magnificent Seven were kind of leading this thing. Now, the earnings are still coming in right now, but I think forward looking, there are some questions about whether the investments in AI are going to pay off anytime soon. So the expectations for continuing earnings reports like we've seen, I think were dimmed a little bit, and that's what's made people pull back.
NVIDIA, the AI computer chip supplier, valued at $3 trillion. I mean, when saying it went up like a rocket is certainly true. And so, that's an expectation of earnings that are impossible to actually confirm. So it's a bet on the future, and a big bet it is. So this reminds me a little bit, Mary, of the dot-com days, in the late 1990s into 2000 or so, when things got a little crazy.
Yeah, but I think there's actually something to AI.
No, there is.
Very different.
But there was to dot-com too.
Yeah. I think we've actually seen the earnings for a lot of these big companies. But again, I think that it's a level of improvement in their price levels that has to be digested. And so most investors are in for the long term. Market timing is not a very easy thing to do. And so I think these are all solid companies that will do well into the next decade. But for now, people are wondering whether or not they're going to be able to sustain the kinds of earnings that they've had. And that's what's caused people to kind of pull back a little bit.
Joe, let's talk about Japan in particular, which you have covered for many years when you were in Asia and, of course, paying attention to it as well now. There was a monetary movement last week on policy. The Bank of Japan finally moving its target rate into 0.25% positive rate. And the Bank of Japan, the president said that the bank is going to also end gradually its quantitative easing program. Big shift for Japan. Did that trigger this huge movement in Japanese markets, and why?
Yes, Paul, I think it did. And this is actually probably a much bigger story for the global economy even than Jerome Powell and the Federal Reserve last week, because Japan for many years has been sort of a Frankenstein's laboratory of monetary policy. They pioneered all of the quantitative easing, the zero interest rates. They kept these policies going much longer into the current tightening cycle than any other central bank in the world. So what is really happening is the Bank of Japan has decided that they do need to start normalizing, both because inflation was ticking up and because it's becoming clear to them that these policies have not been good for the Japanese economy. But when you've been in that experimental environment with these very distorted, abnormal policies for such a long time, inevitably you're going to have to do a lot of repricing when you come out of it. And so that's what's happening now, and it takes a couple intertwined forms. The most important is the yen. The value of Japan's currency relative to the dollar and the euro had fallen pretty significantly over the course of this year, and that was because interest rates in Japan were so much lower than they were anywhere else, and that differential tends to drive a weakness of the currency. And that weak yen had encouraged a lot of foreign investors to pile into the Japanese stock market because the weak yen kind of inflates the yen-denominated profits of Japanese companies, and it also makes those shares seem cheaper to foreigners. And so all of these trades are going into reverse now. That Tokyo is stepping up and saying, no, we think the yen has fallen too far and we're going to start tightening monetary policy. So I suspect that a lot of the selling that we're seeing is foreigners reconfiguring their portfolios in light of the fact that Japan is not going to be continuing with some of these policy experiments in the way that they have been.
So the so-called carry trade, which is borrowing in a cheaper currency to invest in, and in this case, the yen, to invest in dollar assets, that's all unwinding now. And those capital flows shifting exchange rates, and that has real consequences for the Japanese market.
Well, it has consequences for other markets around the world too, because, I mean, remember, the flip side of these foreign capital inflows into the Japanese stock market to take advantage of the cheaper yen, much larger capital outflows for this carry trade that you've described. Both the Japanese themselves and foreigners could borrow yen at ultra low interest rates in the expectation that the currency would continue to depreciate, and then invest in markets like the U.S. So, I mean, huge amounts of this money have poured into the U.S. Treasuries market, for example. So I think that, some of this rapid appreciation of the yen over the past week or so has been driven by a reversal of some of these carry trades, and that's going to have implications for the markets around the world that capital is leaving now.
Right. Okay. We're going to take a break, and when we come back, we'll talk about the implications for economic growth and what the markets may be signaling when we come back. Welcome back. I'm Paul Gigot with the Wall Street Journal here on Potomac Watch, and I'm here with my colleagues Mary O'Grady and Joe Sternberg. We're talking about the big jolt to markets with the stock market sell-off, as well as some concerns about the economy. And let's talk about the real economy, because the financial markets are, of course, only part of it. Friday's jobs report for July was weaker than the reports on average have been over the last year, but not so bad that it's a signal of recession for its own sake. I think the question, Mary, is, are these markets now, are they signaling that there is real concern about a potential recession?
I think at a minimum, the economy is slowing down. The first quarter, we had 1.4% growth, and then we had a little bit stronger, twice as strong in the second quarter. Growth for the third quarter looks still reasonably okay. But as you point out, the disappointing jobs number, which was, not negative jobs, but much fewer than we've been creating for most of the last years since the end of the pandemic. So there's concern that if you start to get a higher unemployment rate, then people are going to have less money to spend. And when there's less money to spend, the economy starts to slow. There's also another concern, I think, here that we can't discount, which is that the role of the federal government in juicing the economy with stimulus and federal spending is diminishing because we have a lot of debt and we really just can't keep spending to the sky. So you saw in the jobs report, not so many government jobs created this last time around. And if there is a slowdown in the economy, we're not going to have the stimulus tools that we've had in the past to counteract that.
No fiscal space.
Exactly.
Yeah.
So I think that is one of the reasons why the market is nervous. And again, I just would repeat that you've had this market that's just gone straight up and even begun to rotate into other sectors besides the high-tech companies. And that's based on expectations that these companies will continue to generate healthy earnings. So if you go into an economic slowdown, which I think is normal, natural, it's a business cycle, I think it's best to let it happen. But that's going to definitely disappoint on the earnings front.
Well, Institute for Supply Management Services index for July was actually up from the previous month into expansion territory, 51.4%. That's not a bad signal. The ISM for manufacturing has been down under 50. But the services report is encouraging. GDP Now, which is the Atlanta Fed's estimate of growth for the third quarter, is still at 2.5%, which would be really good. Of course, that changes with new data, so you can't bank on that. Joe, but there is an argument that consumers at the bottom end of the income scale have tapped out their savings, and that's been showing up somewhat in some of the consumer spending data. They built up a lot of money from the pandemic. That's pretty much gone. Consumers at the upper end have been relying on, in part, the wealth effect they get from higher asset prices. If now we get a big reduction in those asset prices, people are going to feel poorer, a kind of negative wealth effect, as it's called. And as Mary suggested, we've had an economy in many ways built on asset prices. That could hurt the economy going forward.
Yeah, I mean, my main read on the economy right now is that it is a very mixed picture and that actually is an outcome of a lot of the government policies that we've had over the past few years, because you do have all of these contradictory and countervailing phenomenon. And let me point out, by the way, since we started our conversation today talking about the markets, I mean, investors might have forgotten this in the era of easy money, but they do exist to absorb all of this contradictory information. So they're doing their job now, whether they want to or not. But I think for me, the big characteristic of the economy in recent years has been, since the pandemic, we've never really come up with anything other than government spending that could give you a virtuous cycle of economic growth. I mean, the business investment and the GDP reports always seems to be kind of all over the place. Some quarters it's good, some quarters it's not, but it never quite seems to bed in and really become a virtuous cycle in that way. Any of the other things that you would point to where you would think, yeah, if we can get this loop started, it's going to feed on itself in a healthy way. It never quite happens. And so that leaves you very exposed to the ability of the Federal Reserve to help people pump up asset prices with lower interest rates and government spending. To me, this feels a lot like a policy failure, a consequence of regulations and tax policies and bad signals from Washington that have kept the private economy from really being able to unleash itself.
Yeah, I mean, the only real pro-growth policies we've had from the political class were, I think, the 2017 tax reform and tax cut, and then the deregulation of those first couple of years of the Trump years. Everything else has been very much fueled by government spending and by Federal Reserve accommodation of that spending through easy money.